Math skills are an important part of the life and health insurance license exam, testing your ability to make accurate calculations quickly. In this video, we'll cover premium and rate calculations, benefit and payout calculations, and policy values and reserves. And don't miss what's happening in the bottom corner. It's designed to supercharge your exam prep. We'll explain more in just a minute. Let's dive in and get started.
Let's start with a look at premium calculations. Net versus gross premiums. What is the primary difference between net premium and gross premium in life insurance calculations? Is it A, net premium excludes expenses and profit margins, while gross premium includes them? B, net premium includes expenses and profit margins, while gross premium excludes them? C, net premium and gross premium are the same in all calculations. Or D, net premium is always higher than gross premium. The answer is A, net premium excludes expenses and profit margins, while gross premium includes them. Why this question may seem a bit tricky, the distractors might confuse the components of net and gross premiums. Net premium excludes expenses and profit margins, while gross premium includes them. An insurance agent calculates a policy's net premium as $500. If the gross premium includes a 20% loading for expenses and profit, what is the gross premium? Is it A, $520, B, $600, C, $700, or D, $550? The answer is B, $600. Why this question may seem a bit tricky, the distractors might result from incorrect percentage application. The gross premium is calculated by adding 20% of the net premium to the net premium itself.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Which component is typically not included in the calculation of a net premium? Is it A, mortality costs, B, interest earnings, C, expenses and profit margins, or D, policyholder benefits? The answer is C, expenses and profit margins. Why this question may seem a bit tricky. The distractors might include components that are part of the net premium. Expenses and profit margins are not included in net premium calculations. A life insurance policy has a net premium of $800. If the gross premium is $960, what percentage of the net premium is added as loading? Is it A, 10%, B, 15%, C, 18%, or D, 20%? The answer is D, 20%. Why this question may seem a bit tricky. The distractors might result from incorrect percentage calculations. The loading percentage is calculated as $960 minus $800 divided by $800 times 100%. In premium calculations, what does the term loading refer to? Is it A, the basic cost of insurance coverage, B, additional charges for expenses and profit, C, the interest rate applied to premiums, or D, the total amount of premiums collected? The answer is B, additional charges for expenses and profit. Why this question may seem a bit tricky. The distractors might confuse the concept of loading with other terms. Loading refers to the additional charges for expenses and profit added to the net premium. An insurance agent needs to calculate the gross premium for a policy. The net premium is $500 and the loading percentage is 20%. What is the gross premium? Is it A, $520, B, $600, C. $700, or D. $750? The answer is B. $600. Why this question may seem a bit tricky. The distractors may result from incorrect application of the loading percentage. The correct approach is to add 20% of the net premium to the net premium itself. Mortality and interest assumptions. In the context of premium calculations, what does the mortality rate specifically refer to? Is it A, the interest rate used in premium calculations? B, the probability of death within a specific period? C, the rate at which premiums increase annually? Or D, the percentage of policyholders who renew their policies? The answer is B, the probability of death within a specific period. Why this question may seem a bit tricky. The distractors might confuse mortality rate with other insurance terms. Mortality rate is the probability of death within a specific period. An insurance company uses a mortality rate of 0.005 and an interest rate of 3% to calculate premiums. If a policyholder is expected to live for 20 years, what is the expected present value of a $100,000 death benefit? Is it A, $85,000, B, $95,000, C, $88,000, or D, $92,000? The answer is C, $88,000. Why this question may seem a bit tricky. The distractors might result from incorrect application of the present value formula or misunderstanding of mortality impact. Which component of the premium calculation is directly affected by the interest assumption? Is it A, present value of future benefits, B, mortality rate, C, expense loading, or D, policyholder dividends? The answer is A, present value of future benefits. Why this question may seem a bit tricky. The distractors might confuse interest with other factors. Interest affects the present value of future benefits. A life insurance policy uses a mortality rate of 0.004 and an interest rate of 4%. If the expected payout is $200,000 in 15 years, what is the present value of this payout? Is it A, $150,000, B, $120,000, C, $180,000, or D, $160,000? The answer is B, $120,000. Why this question may seem a bit tricky. The distractors might result from incorrect discounting or ignoring the mortality rate. What is the primary purpose of using interest assumptions in premium calculations? Is it A, to estimate future mortality rates, B, to calculate administrative expenses, C, to determine policyholder dividends, or D, to calculate the present value of future payouts? The answer is D, to calculate the present value of future payouts. Why this question may seem a bit tricky. The distractors might confuse interest assumptions with other financial metrics. Interest assumptions help determine the present value of future payouts. An insurance agent needs to calculate the premium for a life insurance policy. The mortality rate is 0.002 and the interest rate is 3%. If the benefit amount is $100,000, what is the net premium using the formula? Net premium equals benefit amount times mortality rate divided by 1 plus interest rate. Is it A, $200, B, $194.17, C, $206, or D, $198? The answer is B, $194.17. Why this question may seem a bit tricky. The distractors might result from incorrect application of the formula or miscalculation of the interest rate. The correct approach is to substitute the values into the formula and solve.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Policy values and reserves. Cash value growth calculations. What is the primary purpose of calculating the cash value growth in a life insurance policy? Is it A, to determine the policy's premium payments? B, to assess the policy's investment performance over time? C, to calculate the death benefit? Or D, to set the policy's surrender charges? The answer is B, to assess the policy's investment performance over time. Why this question may seem a bit tricky. The distractors focus on unrelated aspects of policy management. The correct answer involves understanding the role of cash value in policy growth. An insurance agent needs to calculate the cash value growth for a policy with an initial cash value of $10,000, an annual interest rate of 5%, and no withdrawals. What will be the cash value after 1 year? Is it A, $10,050, B, $10,500, C, $11,000, or D, $9,500? The answer is C, $11,000. Why this question may seem a bit tricky. The distractors include common calculation errors, such as incorrect interest application. The correct approach is to apply the interest rate to the initial cash value. Which component of the cash value growth formula represents the interest rate applied to the policy's cash value? Is it A, R, B, C, or D, S? The answer is A, R. Why this question may seem a bit tricky. The distractors use terms that are not directly related to interest rates. The correct answer involves identifying the interest rate component. A policyholder wants to know the cash value growth after 3 years for a policy with an initial cash value of $15,000 and an annual interest rate of 4%. Assuming no withdrawals, what will be the cash value? Is it A, $15,600, B, $16,800, C, $17,472, or D, $16,872? The answer is D, $16,872. Why this question may seem a bit tricky. The distractors include errors in compounding interest. The correct approach is to apply the compound interest formula over 3 years. In the context of cash value growth calculations, what does the term compounding refer to? Is it A, the process of calculating premiums, B, the method of determining surrender charges, C, the accumulation of interest on both principal and previously earned interest, or D, the adjustment of policy terms? The answer is C, the accumulation of interest on both principal and previously earned interest. Why this question may seem a bit tricky. The distractors confuse compounding with unrelated financial terms. The correct answer involves understanding the accumulation of interest on both the initial principal and accumulated interest. An insurance policy has a cash value of $10,000 at the beginning of the year. If the policy guarantees a 4% annual interest rate, what will be the cash value at the end of the year? Is it A, $10,400, B, $10,800, C, $9,600, or D, $10,040? The answer is B, $10,800. Why this question may seem a bit tricky. The distractors use incorrect interest calculations or ignore the compounding effect. The correct approach is to multiply the initial cash value by 1.04. Policy loans and interest accrual. What is the primary purpose of a policy loan in the context of life insurance policy values? Is it A, To increase the death benefit. B. To borrow against the cash value. C. To pay premiums automatically. Or D. To reduce the policy's cash value. The answer is B. To borrow against the cash value. Why this question may seem a bit tricky. The options include terms that might sound similar but have distinct meanings. A policy loan allows the policyholder to borrow against the cash value of their policy. An insurance policy has a cash value of $10,000. If a policyholder takes a loan of $4,000 at an interest rate of 5% per annum, what will be the interest accrued after 1 year? Is it A, $100, B, $150, C, $200, or D, $250? The answer is C, $200. Why this question may seem a bit tricky. The distractors may result from miscalculating the interest or using the wrong principal amount. The interest is calculated as $4,000 times 0.05 equals $200. Which component of a policy loan affects the policy's cash value over time? Is it A, interest accrual, B, premium payments, C, death benefit, or D, policy dividends? The answer is A, interest accrual. Why this question may seem a bit tricky. The options include terms that are related but not directly responsible for cash value changes. Interest accrual affects the cash value as it increases the loan balance. A policyholder has an outstanding loan of $2,500 on their life insurance policy. If the annual interest rate is 6%, what will be the total loan balance after 1 year, including interest? Is it A, $2,580, B, $2,650, C, $2,700, or D, $2,750? The answer is B, $2,650. Why this question may seem a bit tricky. The distractors may arise from incorrect interest calculations. The total balance is $2,500 plus $2,500 times 0.06 equals $2,650. In the context of policy loans, what does the term interest accrual refer to? Is it A, the initial loan amount, B, the policy's cash value, C, the premium payments, or D, the accumulation of interest over time? The answer is D, the accumulation of interest over time. Why this question may seem a bit tricky. The options include terms that are related but not synonymous. Interest accrual refers to the accumulation of interest on the outstanding loan balance over time. An insurance policyholder takes a policy loan of $5,000 at an annual interest rate of 6%. If the interest is compounded annually, what will be the total amount owed after 2 years? Is it A, $5,600, B, $5,720, C, $5,618, or D, $5,900? The answer is C, $5,618. Why this question may seem a bit tricky. The distractors might result from using simple interest instead of compound interest. Compound interest requires applying the formula A equals P times open parenthesis 1 plus R, close parenthesis, raised to the power of N. Annuity payout calculations. Fixed annuity payment formulas. What is the primary purpose of the fixed annuity payment formula in annuity payout calculations? Is it A, to calculate the regular payment amount from a fixed annuity, B, to determine the interest rate of an annuity, C, to estimate the future value of an annuity, or D, to calculate the tax implications of annuity payments? The answer is A, to calculate the regular payment amount from a fixed annuity. Why this question may seem a bit tricky. The distractors might confuse the purpose of the formula with other financial concepts. The formula is specifically used to determine the regular payment amount from a fixed annuity. An insurance agent needs to calculate the monthly payment for a fixed annuity with a present value of $100,000, an annual interest rate of 5%, and a term of 20 years. What is the monthly payment? Is it A, $500, B, $659.96, C, $833.33, or D, $416.67? The answer is B, $659.96. Why this question may seem a bit tricky. The distractors use incorrect interest rate conversions or term lengths. The correct approach involves using the fixed annuity payment formula with monthly interest and term adjustments. In the fixed annuity payment formula, what does the term N represent? Is it A, the annual interest rate, B, the present value of the annuity, C, the total number of payment periods, or D, the future value of the annuity? The answer is C, the total number of payment periods. Why this question may seem a bit tricky. The distractors might confuse N with other variables. N specifically represents the total number of payment periods in the annuity term. A retiree wants to receive a fixed monthly payment from an annuity with a present value of $200,000, an annual interest rate of 4% over 15 years. What is the monthly payment? Is it A, $1,333.33, B, $1,111.11, C, $1,250, or D, $1,479.38? The answer is D, $1,479.38. Why this question may seem a bit tricky. The distractors use incorrect interest rate or term conversions. The correct answer requires adjusting the annual rate and term to monthly values in the formula. Which component of the fixed annuity payment formula accounts for the interest earned over time? Is it A, the present value, B, the interest rate, C, the payment period, or D, the annuity term? The answer is B, the interest rate. Why this question may seem a bit tricky. The distractors might confuse the interest component with other parts of the formula. The interest rate is the component that accounts for earnings over time. A retiree wants to receive a fixed annuity payment of $1,000 per month for 20 years. If the interest rate is 5% per annum, compounded monthly, what is the present value of the annuity? Use the fixed annuity payment formula. Is it A, $150,000, B, $180,000, C, $186,253, or D, $200,000? $200,000. The answer is C, $186,253. Why this question may seem a bit tricky. The distractors may result from using the wrong interest rate or time period. The correct approach is to apply the present value of annuity formula using the monthly interest rate and total number of payments.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Variable annuity unit value calculations. What is the primary factor that affects the calculation of a variable annuity unit value? Is it A, interest rate changes, B, investment performance of subaccounts, C, policyholder's age, or D, inflation rate? The answer is B, investment performance of subaccounts. Why this question may seem a bit tricky. The distractors might confuse the primary factor with secondary influences. The correct answer focuses on the investment performance of the underlying subaccounts. In the context of variable annuity unit value calculations, what does the term unit value refer to? Is it A, the initial investment amount, B, the total number of units, C, the current value of each unit, or D, the payout amount? The answer is C, the current value of each unit. Why this question may seem a bit tricky. The distractors might confuse you with similar sounding terms. The unit value is the current value of each unit in the annuity. Which component is essential in calculating the variable annuity unit value? Is it A, net asset value of subaccounts, B, mortality and expense risk charge, C, surrender charge, or D, administrative fees? The answer is A, net asset value of subaccounts. Why this question may seem a bit tricky. The distractors might seem relevant but are not directly used in the calculation. The net asset value of the subaccounts is crucial. A variable annuity has a unit value of $12. If the net asset value of the subaccounts increases by 8%, what will be the new unit value? Is it A, $12.08, B, $12.96, C, $13.20, or D, $11.04? The answer is B, $12.96. Why this question may seem a bit tricky. The distractors may result from incorrect percentage application. Multiply $12 by 1.08 for the correct new value. When calculating the variable annuity unit value, what does the term accumulation unit refer to? Is it A, the payout phase units, B, the interest earned, C, the fees charged, or D, investor share in subaccounts? The answer is D, investor share in subaccounts. Why this question may seem a bit tricky. The distractors might confuse accumulation units with payout units. Accumulation units represent the investor's share in the subaccounts during the accumulation phase.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Health insurance benefit calculations. Coinsurance and deductible computations. What is the primary purpose of a deductible in a health insurance policy? Is it A, to cover all medical expenses, B, to reduce the insurer's risk by requiring the insured to pay initial costs, C, to determine the premium amount, or D, to calculate coinsurance? The answer is B, to reduce the insurer's risk by requiring the insured to pay initial costs. Why this question may seem a bit tricky. The distractors confuse deductible with other terms like coinsurance and premium. Deductibles are the amount paid out of pocket before insurance covers costs. An insured individual has a health plan with a $500 deductible and 20% coinsurance. If they incur the $2,500 medical bill, how much will they pay out of pocket? Is it A, $500, B, $1,000, C, $900, or D, $2,000? The answer is C, $900. Why this question may seem a bit tricky. The distractors may mislead by ignoring the deductible or miscalculating coinsurance. First, subtract the deductible, then apply coinsurance to the remaining amount. In health insurance, what does coinsurance represent? Is it A, The percentage of costs shared by the insured after the deductible is met. B. A fixed amount paid for each medical service. C. The total amount paid before insurance covers any costs. Or D. The monthly payment for maintaining insurance coverage. The answer is A. The percentage of costs shared by the insured after the deductible is met. Why this question may seem a bit tricky. The distractors confuse coinsurance with other terms like copayment and deductible. Coinsurance is the percentage of costs shared after the deductible is met. A policyholder has a $1,000 deductible and 30% coinsurance. After meeting the deductible, they receive a $5,000 medical bill. How much will the insurance company pay? Is it A. $1,500, B. $2,000, C. $3,000, or D. $3,500? The answer is D. $3,500. Why this question may seem a bit tricky. The distractors may mislead by misapplying coinsurance. After the deductible, the insurer pays 70% of the remaining $5,000. Which step is necessary to calculate the out-of-pocket cost after a deductible is met? Is it A. Add the deductible to the total bill, B. Multiply the total bill by the premium rate, C. Apply the coinsurance percentage to the remaining bill, or D. Subtract the copayment from the total bill? The answer is C. Apply the coinsurance percentage to the remaining bill. Why this question may seem a bit tricky. The distractors include irrelevant steps. After meeting the deductible, apply the coinsurance percentage to the remaining bill. Daily benefit and maximum out-of-pocket formulas. What is the primary purpose of the daily benefit formula in health insurance calculations? Is it A. To determine the amount paid per day for covered services, B. To calculate the total annual premium, C. To assess the policyholder's credit score, or D. To establish the deductible amount? The answer is A. To determine the amount paid per day for covered services. Why this question may seem a bit tricky. The distractors focus on unrelated insurance terms. The daily benefit formula is used to determine the amount paid per day for covered services. In health insurance, what does the maximum out-of-pocket formula calculate? Is it A. The total premium paid annually, B. The most a policyholder will pay for covered services in a year, C. The deductible amount, or D. The policyholder's annual income? The answer is B. The most a policyholder will pay for covered services in a year. Why this question may seem a bit tricky. The distractors use unrelated insurance terms. The maximum out-of-pocket formula calculates the most a policyholder will pay for covered services in a year. A policyholder has a maximum out-of-pocket limit of $5,000. If they have already paid $3,000 in covered expenses, how much more can they expect to pay? Is it A. $8,000, B. $2,000, C. $5,000, or D. $3,000? The answer is D. $3,000. Why this question may seem a bit tricky. The distractors involve incorrect subtraction or misunderstanding of the limit. The remaining amount is found by subtracting the paid expenses from the maximum limit. If a health insurance policy has a daily benefit of $200 and a maximum out-of-pocket of $4,000, how many days of hospitalization would it take to reach the maximum out-of-pocket limit? Is it A. 10 days, B. 20 days, C. 30 days, or D. 40 days? The answer is B. 20 days. Why this question may seem a bit tricky. The distractors involve incorrect division or misunderstanding of the limit. Divide the maximum out-of-pocket by the daily benefit to find the number of days. An insurance policy offers a daily benefit of $150 and a maximum out-of-pocket limit of $5,000. If a policyholder incurs $4,500 in covered medical expenses, how much will they pay out of pocket? Is it A, $0, B, $500, C, $4,500, or D, $5,000? The answer is B, $500. Why this question may seem a bit tricky. The distractors might confuse the daily benefit with the out-of-pocket limit. The correct approach is to subtract the daily benefit from the total expenses until reaching the out-of-pocket limit. Taxation and settlement calculations. Taxable portion of annuity or settlement. What is the primary purpose of the exclusion ratio in calculating the taxable portion of an annuity? Is it A, to determine the non-taxable portion of each annuity payment? B, to calculate the total tax due on an annuity? C, to decide the annuity payment frequency? Or D, to establish the annuity's interest rate? The answer is A, to determine the non-taxable portion of each annuity payment. Why this question may seem a bit tricky. The options might confuse the exclusion ratio with other tax concepts. The exclusion ratio determines the non-taxable portion of each annuity payment. An annuitant receives $1,000 monthly from an annuity. The exclusion ratio is 0.3. What is the taxable portion of each payment? Is it A, $300, B, $700, C, $1,000, or D, $0? The answer is B, $700. Why this question may seem a bit tricky. The exclusion ratio is used to find the non-taxable portion, not the taxable portion directly. Multiply $1,000 by 1 minus 0.3 to find the taxable amount. Which component is necessary to calculate the exclusion ratio for an annuity? Is it A, the annuitant's age, B, the annuity's interest rate, C, the investment in the contract, or D, the annuity's payment frequency? The answer is C, the investment in the contract. Why this question may seem a bit tricky. The options include terms that might seem relevant. The investment in the contract is essential for calculating the exclusion ratio. A retiree invested $120,000 in an annuity and expects to receive $200,000 over its term. What is the exclusion ratio? Is it A, 0.6, B, 0.4, C, 1.67, or D, 0.2? The answer is A, 0.6. Why this question may seem a bit tricky. The exclusion ratio is the investment divided by expected return. Divide $120,000 by $200,000. In calculating the taxable portion of an annuity, what does the exclusion ratio represent? Is it A, the total annuity payment, B, the taxable portion of the annuity, C, the portion of the payment that is not taxable, or D, the investment in the contract? The answer is C, the portion of the payment that is not taxable. Why this question may seem a bit tricky. The distractors might confuse the exclusion ratio with other financial terms. The exclusion ratio is the portion of the annuity payment that is not taxable.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.